Thank you. As was mentioned, my name is Jason Sanders. I'm a tax partner here at BNV, and I will be the moderator for this session. With me today, I have two of my fellow partners, Lesley Sciortino and Jason Sharp. Lesley is an audit partner with Briggs & Veselka in our Houston office and leads our retail industry sector. Lesley has been with the firm for 2 years. Prior to joining BNV, Lesley was an audit partner in the Houston office of Deloitte & Touche for 21 years. Lesley's experience includes serving public and private clients in fields of retail, financial services, manufacturing, as well as many other industries. Jason Sharp is a tax partner at BNV and has been with the firm for over 8 years. Jason is a CPA and a licensed attorney and has over 25 years of experience in just about every aspect of business and individual taxation. In addition, Jason also focuses on mergers and acquisitions and corporate and partnership restructurings. Now that everyone knows the team, I want to remind you that this session is eligible for CPE credit. All you need to do to qualify is to answer the polling questions. So with those housekeeping items out of the way, I'll go ahead and proceed to the tax update. But prior to doing that, we will take a look at our first polling question of the day. Okay, so while you guys are finishing answering the polling questions, I'll go ahead and get started. So 2020 has proven to be a year of change and a year of pivoting, and tax law is certainly no exception. My presentation this morning will focus on a number of new laws that were enacted with the passage of the CARES Act earlier this year. So with the first slide, we're going to talk a little bit about net operating losses. This is a provision that a number of our clients have actually already taken advantage of and are in the process or have already filed carryback claims to recoup taxes that were previously paid. So under the prior law, losses were carried forward indefinitely and were limited to 80% of taxable income in all future years. The CARES Act amends the prior law to allow for the carryback of losses to each of the 5 preceding years. And in addition, it also eliminates the 80% taxable income limitation. This provision is effective for tax years 2018, 2019, and 2020. A really neat feature about this change revolves around the change in tax rates that we experienced in 2018. And so, for example, the corporate tax rates are currently 21% and are set to remain at 21% going forward. And that change occurred in 2018, as I mentioned. Prior to 2018, the maximum rate for corporations was 35%. So rather than having to carry forward losses that can be used to offset income at a 21% rate, we are able to actually carry back those losses and recoup taxes that were paid, in some cases, at much higher tax rates. So that's a real big benefit to a lot of taxpayers. The other concept I want to speak about on this slide is excess business losses. So excess business losses, this is for non-corporate taxpayers. And this was a provision that was brought into tax law in 2018, and it has since now been removed for the same years as the NOL changes. So 2018, 2019, and 2020. And the way this worked were any losses in excess of $500,000 were suspended, and those losses were then carried forward to future years where they were converted to NOLs and then made subject to the 80% limitation. So the good news here is that at least for 18, 19, and 20, we do not have to worry about excess business losses, and we will not have to review those rules again until 2021. So moving on, the next thing I'd like to take a few minutes to discuss is qualified improvement property. So what is qualified improvement property? So essentially qualified improvement property is, basically what we used to refer to as leasehold improvements. And then included in that category are also qualified retail improvements, qualified retail property and qualified restaurant property. The Tax Cuts and Jobs Act of 2017 contained a drafting error, and that drafting error resulted in qualified improvement property having a useful life of 39 years, as opposed to the intended life of 15 years. So what the result of that was is that it made this class of property not eligible for bonus depreciation. So the CARES Act corrects this mistake and now properly classifies qualified improvement property as 15-year property, which also now makes it eligible for bonus depreciation. And for those of you, most of you are probably aware, bonus depreciation means we have 100% write-off in the year of acquisition, and that provision is good through 2022. A key note to take in mind or to consider here is that this change is actually also retroactive. So this goes back to 2018. So taxpayers who've already filed 2018 tax returns, which obviously would be most, if not all, they have two options at this point. Number one, we can amend the 2018 return to claim the proper deduction, or you can catch up the deduction on a current year return by using a change of accounting method election. And the way that works is essentially you take the delta of what you claimed as a deduction versus what you would have been able to claim as a deduction, and you take that in the current year. So let's say in 2018, you took a deduction of $20,000, but you were really entitled to a deduction of $400,000 had bonus depreciation been applied. The difference is $380,000. So again, you can amend the return to claim the full 400, or you can in your current year catch it up and take a deduction of $380,000 on your current year tax return. So it's a big win for a lot of taxpayers and something that's going to have a huge impact on many of our clients. Okay, so next we'll move on to retirement plan provisions. Three things I want to cover here. The first one are distributions for COVID purposes. So typically any distribution from a qualified retirement plan prior to reaching the age of 59 and a half is subject to a 10% penalty. Now, the CARES Act provides that the 10% tax or penalty does not apply to COVID-related distributions, and that is good up to an amount of $100,000. So again, this should provide benefit to those who have been affected by COVID. A couple of key things within this provision. First off, is that, again, this distribution is taxable, but it's not subject to the 10% tax. However, it is taxable under ordinary rates. However, if the taxpayer repays the distribution at any point in a 3-year period, then the distribution becomes non-taxable. So taxpayers actually have the opportunity to repay the distribution. If the distribution is not repaid, then again, it becomes taxable. And the taxpayers, fortunately, do not have to bring it all into income in 2020. We actually get to spread that out over a 3-year period. So by way of example, let's say a taxpayer takes a distribution of $90,000. 2020, they would have income of $30,000, 2021, $30,000, and then finally in 2022, the remaining $30,000 would be taxable. And then traditionally, any early distributions do require that 20% federal withholding be done. But for purposes of these qualified distributions, that 20% withholding is not required. Okay. So next we'll talk about retirement plan loans. Not a whole heck of a lot here, just more of an FYI. Loans from qualified plans, the amount was doubled from $50,000 to $100,000. So now taxpayers are eligible to take loans up to $100,000 from their employer plans. And then for any loans that were outstanding prior to the enactment of the CARES Act, no payments are needed or required during the calendar year 2000. Delay for 1 year. So basically, no payments need to be made in 2000, and once the 1 year period ends, payments just begin back from where they were when you left off. Okay, so next let's talk about required minimum distributions. So requirement minimum distributions are not required in 2020. So for those of you who do not know, typically, these are required, or distributions from IRAs or other retirement plans are required once an individual turns 70 and a half prior to 2020, and then that was to change to 72 in 2020. But in response to the COVID crisis, the CARES Act eliminated the requirement that distributions have to be made. For those who had already received their required minimum distribution, they are now allowed, those individuals are now allowed to repay the contribution, so basically to deposit it back into the plan. And the date to do that has recently been extended to August 31st, 2020. So I guess we have roughly 25 days to make that back and or get those things back into the plan. Okay. So next, we'll move on to charitable contributions. So the CARES Act suspends the 60% AGI limitation on charitable contributions for 2020. So for those of you not aware of this rule, taxpayers are limited to receiving a deduction of 60% of their adjusted gross income. So let's say, for example, a taxpayer has adjusted gross income of $1 million. His current year deduction for charitable contributions would be $600,000. Well, for 2020, that 60% limitation is completely wiped out. Therefore, that same taxpayer should, had they made additional contributions, would be allowed to do that all the way up to reduce their adjusted gross income or taxable income down to zero. Also, for taxpayers that do not itemize, the CARES Act also provides an above-the-line deduction of up to $300 for contributions to qualified charities. So this is above and beyond what you would already get to claim as a standard deduction. Now, it's key to note that the suspension is applicable only to cash contributions, and unfortunately, it does not apply to contributions to donor-advised funds. Related to corporations, the CARES Act also increased the limitations. So corporations have a similar restriction on deductibility of charitable contributions. Is actually much more restrictive. It's 10% of taxable income, but for 2020, that amount has been increased to 25% of taxable income. And then also the similar limitation for contributions of food inventory has also been increased from 15% to 25%. The final slide I have here, this quite honestly is not related to the CARES Act. This is just more, more just current market environment. So really, we feel like with the current tax and current economic conditions the way that they are, this really presents a very unique opportunity for taxpayers to consider gifting and estate planning strategies. You'll see the chart here, which illustrates the lifetime exemption amount for gifts and estate tax purposes from 1997 through 2020. And if I know there's no numbers on here, but back in 1997, the amount was only $600,000. Currently, that amount is $11.58 million per individual. So that a married couple obviously would be twice that amount. So quick math there would be just over $23 million. So with the inflated exemption amount coupled with the likelihood that many companies will have depressed valuations due to the current economic environment, it's really a perfect storm, really, for estate planning possibilities and opportunities. So, for those of you who maybe have not gotten to a point to where you've begun estate planning, but even if you have an estate plan in place, it may be an opportune time to really refresh, take another look at it, and see if there's any possibility that you can use the state of the current economy to your advantage to remove more assets from your estate and move it on to the next generation. And just as a very, very shameless plug here, Briggs & Maselka does have a wonderful and experienced gift and estate planning team, as well as a fantastic business valuation team. Those two groups work together quite a bit and have helped many of our clients solve some very complex succession planning needs. So I would encourage you to reach out to them when and if you do have a need in this area. So with that about brings me to the end of my presentation. So I think now maybe would be a good time to take a look at our polling results. Okay, so how do you anticipate inventory existence testing will be performed for your 2020 year-end audit? It's very small on my screen, but it looks like video observation procedures is the winner at 46%. I got to be honest with you, as a tax guy, I'm not even 100% sure what some of this means, but I think I do. So interesting. I certainly, with the environment that we're currently in, we're all learning new things and learning the use of new technologies. So interesting that, it will be video and not manually done this year. So that's great. I appreciate everyone taking part in the poll. So next, what we're going to do, we're going to change gears a little bit, and we're going to bring Jason Sharp up next. And Jason is going to give us an overview of Washington's response to COVID-19. So Jason, the floor is yours.
Okay, good deal. You guys hear me okay? I guess we're going to do our second polling question. This one is just sort of what percent of your workforce is currently working remotely. I've had various clients with various answers to that, so it'll be interesting to sort of see where that comes out. And it would be interesting actually to probably check this, later on in the year and see how things are different. So we'll continue. We'll look back at this again here at the end of my speaking time and see where we landed. So, sort of thinking of Washington's response to the COVID situation, they started with a phased approach, and a lot of this will be. So, phase one was. They postponed a lot of the tax deadlines from April to July. I'm sure most of you guys are already aware of that, and that has come and gone. But that was a great help to many people. It deferred a lot of potential tax payments for a few months. Cash is king in these times, and so that provided a welcome respite. The second phase was the FFCRA, Families First Corona Response Act. That was one, to refresh your memory, where a lot of businesses that maybe didn't have robust leave, vacation policies, they were encouraged and incentivized to offer time off for employees through various payroll tax credits and similar such devices and tools, and allowed people who needed to take time off either because of direct impact or indirect impact caring for somebody, or children not having school, those types of things. That came out in the middle of March. There really hasn't been many changes to it. There's been a lot of clarification from the Department of Labor, who sort of oversaw that. There really hasn't been that much change, though. So whatever was in place then is still in place. Like I said, there's been a lot of clarification, but not a lot of changes. Phase three was the really big one. So that was the CARES Act, which came in at the end of March. That had a lot of tax law changes, which Jason just talked about. And it also had, of course, the PPP loans, which have been very significant for a lot of people. So the thought at the time, I believe Washington was fairly optimistic when they did phase 2 and 3, that we're going to kind of hunker down. People are going to work remote, stay at home, and in a couple of months, this will all be over. So the FFCRA and the CARES Act sort of anticipated more of a 2 to 3 month situation, which obviously we're well beyond. So they kind of stopped calling their things phases now. But we did have an adjustment to the PPP loan. There was the PPP Flexibility Act, which came in the beginning of June. That significantly extended a lot of the provisions of the PPP loan, made it a little easier to get the forgiveness, extended some time periods, widened some buckets that you could have expenses in. So that was very favorable to the folks who had participated in the PPP loan program. And the next one that came out is the Main Street Lending Program. I'm going to go into a little more detail about that here in a minute. That one hasn't really taken off, I don't think, as they anticipated. It's more of a traditional loan, but we'll talk about that more in a minute. And then are we going to have more legislation? And that's been in the news a lot. So if we move on to the next slide, I sort of have a comparison, and I have to admit, I really don't like talking about proposals because they can change so drastically. I mean, me trying to predict what Congress is going to do, I'd probably have a better shot predicting my teenage daughter's thoughts. So here, for what it's worth, is sort of where the two proposals stand right now. On the left of the slide is sort of the Democratic House proposal, and on the right-hand slide is the Republican Senate proposal. So one's called the HEROES Act, one's called the HEALS Act. I just love how someone must get paid an amazing amount of money to come up with these really clever names. But as you can see, to me, the first indication of how far apart they are is look at that first line, the price tag of the two proposals. One is at $3 trillion and one is at $1 trillion. So obviously we have an insanely large gap here that we're going to have to sort of negotiate through. This slide also does not have all of the differences, but kind of goes through some of the bigger ones. So there's differences in the stimulus money that's going to go, how it's going to be calculated based on dependents. Unemployment is a really big sticking point and very big difference between the two proposals. There's some eviction protection for folks who are without work and unable to continue to pay rent. That is a very big difference and has a big price tag in it. There's also numerous differences in how the school situation is going to be handled, what sort of resources are going to be provided to schools. There's also been a lot of discussion about liability protection between, can you sue your employer if you end up getting it? Can you sue a hospital? Can you sue your school? They want to offer some sort of protection for these institutions because, this is such a novel situation. It doesn't really seem fair to place blame. And so they're trying to, sort of wrestle with that. Also, there's been a lot of talk about funds and resources for additional testing, how that's going to be rolled out, what the dollars are going to be. Is it controlled by the feds? Is it controlled by states? So, like I said, I think at the end of the day, this kind of gives you an idea of what might be coming down the road. But it's really too early to tell, and I wouldn't put much stock in this because this stuff can change drastically. For example, when we looked at the PPP loan program through the CARES Act before it came out, 2 or 3 days before, the potential money you could borrow was 2.5 times what it was in the final act. And that was just a few days before it was passed into law. So, I just use that as an example for how monumentally this stuff can change at the last minute. So don't take a whole lot of stock in this. This, like I said, just sort of gives you an idea of the kind of things they're thinking about. There was also some talk yesterday. They were talking about additional PPP loans, perhaps, but they wanted to restrict it a little bit and make sure it's for companies who truly need it. Instead of, I think they felt like the way they wrote the last one, there were certain folks taking advantage of the PPP loans that maybe weren't in dire need. And so they were trying to be a little more restrictive, and they're talking about 50% revenue drop, and you would have to demonstrate that in order to qualify. A lot of businesses have come out and said, so many businesses operate on very razor thin margins. And so a 20 to 25% drop could be devastating. And so there's been a lot of people asking Congress and the Senate to really rethink that provision. So while it's maybe a good idea, just maybe dialing it back a little bit. So again, stay tuned. This probably isn't going to get resolved in the next few days. It'll probably take a couple of weeks, I would suspect, but we'll just have to wait and see. Next slide. So this is another really hot topic that has confused a lot of people, and we've had lots of clients asking questions about it. And I'm going to tell you today, we still don't really know where this is going to end up. But so sort of as a backdrop to this, within the CARES Act, or even backing up a little further from that, if you make a loan, or if you're a business and you take a loan and that loan is forgiven, in typical circumstances, the amount of the loan that's forgiven becomes taxable income, cancellation of debt income. So the lender can take it as a deduction and you have to pick it up as income. So when they did the CARES Act, they were very explicit in the statutory language that the CARES Act, if you did have a loan that was ultimately forgiven, that it was not to be taxable. That is right in the face of the statute. It's very easy, plain and simple to read. Well, after the CARES Act came out, about a month later, the IRS released a notice and they said, hey, that's great. We're not going to tax you on the forgiveness. But oh, by the way, there's some other provisions within the Internal Revenue Code that say if you do this, that you should not get any deductions for amounts that are forgiven. So in other words, if I got a $1,000 PPP loan and I used it all for appropriate expenses, rent and wages, and I got the full $1,000 forgiven, that $1,000 being forgiven is technically not taxable. However, the IRS says whatever deductions I got on the money I spent, so the wages and the rent, that those are no longer deductible. So that's kind of a backdoor way of making the loan forgiveness taxable. So a lot of people really took issue with this. First of all, they felt like the IRS had overstepped their boundaries, that they're basically changing a statute, which the IRS is not authorized to do. Obviously, only Congress and the Senate can write law. Others said that it, completely contradicted the existing statute. So initially, there was some senators who, within a matter of days, had proposed legislation to amend the CARES Act and make any deductions paid with forgiven money to be fully deductible. As I said, this came out in April. Those bills were proposed in early May, and here we are in August, and nothing has been passed. A lot of people think by the end of the year, something will be done to make those deductions or to make that money deductible. At the present time, it is not. So again, whatever portion of your loan you got forgiven is potentially a reduction in deductions. So basically it's going to be taxable. At the end of the day, paying tax on $100 is better than not getting the $100. So we'll just have to wait and see where this shakes out. It's such an unusual situation because typically you don't see any kind of significant legislation in an election year. So, I don't know what role that plays into it. So some commentators think they know exactly what's going to happen, but they don't want to say anything before the election. And so something will happen in December. So who knows? Just sort of be aware of that and factor that in when you're making your tax plans, because as of right now, forgiven money is not deductible according to the IRS. Next slide. As I mentioned, this is the Main Street Lending Program. So this was put out by the Federal Reserve. So it was kind of a different animal than PPP loans. There's no forgiveness aspect to it at all. This was designed to help the bigger folks who were excluded from PPP loans. Either they had too many employees or things like that. So I will be honest, this thing has not really taken off the way people anticipated. To give you an idea, I think we saw a statistic at the beginning of this week or the end of last week that they had allocated $600 billion to be loaned out. And as of last week, $84 million had been loaned out. There were applications for about another 300 or 400 million. So even if those get approved, you're looking at $500 million of the $600 billion has gone out, and it's been open for quite a while. So this does not look like anything that is really being utilized like, say, the PPP loans were. From what we're hearing, it's kind of one of those situations of if you qualify for the loan, then you probably don't need it. So anyway, like I said, I'll mention it here, but we have not had any clients take advantage of it, and just nationwide, very few people have. Next slide. And I will just sort of mention this. The IRS has come out and said, they were shut down just as many businesses were. So if any of you are having any issues with the IRS or questions, inquiries, responding to notices, having to deal with them, Godspeed. They came out yesterday actually and announced that, like, for example, if you sign a power of attorney to allow me to talk to the IRS on your behalf, those used to take 5 days to process. They're now taking 15 days. And that is something that was very routine, very simple. And so you can see if something that easy and routine is jammed up, you can only imagine something that's very complicated. So, and this is on top of the fact that the IRS budgets have been slashed for the last 5 or 6 years in a row. So they were already understaffed. Their computer system is basically kind of a late 90s, early 2000s level system. So I know the IRS usually can't play the victim card very well, but they are really hamstrung right now. So if you do have any issues with them, it's going to take a while. And I think the last slide I just wanted to point out. So you can see here, we have a link to a lot of presentations and other information on the PPP loans and things like that. The link is SBA loans because that's what we were getting the most questions about. And we don't want to change the name of the link in case people want to come back, but we have a lot more information on that webpage than just SBA loans. So I would just recommend you take a look over there. We have the PowerPoints and the videos of some of our prior ones. So enjoy, and thank you guys. If we can see the results, the final results of the polling question. Okay, wow, half the folks are working completely remote. So that's interesting. Thank you for participating, and I'll turn it back to the other Jason.
Thank you, Jason. Well done. Before we move on to Lesley's presentation, I just want to reiterate that we will have a Q&A session that will go for 5 or 10 minutes at the conclusion of Lesley's presentation. So please continue to post your questions in the Q&A box at the bottom of the Zoom screen. Okay, so with having said that, we will now shift gears and Lesley will provide an update, an audit update. So Lesley, you have the floor.
Thank you, Jason, for that. Let me just a little adjustment. Welcome to B&B's Audit and Accounting Update portion of B&B Insight section. We're certainly living in unprecedented times now with COVID-19, and the regulators have acknowledged that. And in response to that, there's several new standards that they have issued in the current year to divert the implementation of a lot of standards that were set to go into effect in 2020 to help alleviate the burden on companies. During these times, many companies have had to adjust the way that they're running their businesses, as well as, the auditors, when they come in to audit those financial statements, we're likely going to also have to adjust some of the audit procedures that we perform in response to that, particularly as it relates to inventory, if you'll see in this slide. And I think you saw in the polling questions how some companies are actually going to switch to a different method of observation. But certainly the question is, is it allowed, are the auditors allowed to not have to physically be present in an inventory count? And certainly the standards do allow for that. If there's a situation where the auditor's health or safety poses a threat because of where the inventory is held, certainly there's alternative procedures that the auditors can perform in order to do that inventory existence testing. Next slide. You'll see on this slide just some of the ways that inventory price testing by the auditors can be performed. Traditionally, companies go out at the end of the year, they do their count, the auditors are out there on site as well, performing their count and testing procedures. But I have seen where other companies have also at certain times, due to unique situations where they've done, an observation after year end, and the auditors then have to do some additional procedures to roll back the count to get comfortable with year end balances. So roll back and roll forward are two procedures that have been performed in the past by companies or the auditors and can be done again. I think the new thing and what we saw really in the polling question is the video observation method. That likely is going to be the method that's going to have to be used by a lot of companies this year. And the big question with that, though, is it going to be such that it's a live feed or something that the auditors can observe as the company is doing that count, or is it going to be something that the auditors won't be able to observe via Skype or Zoom? And if not, there's just going to be additional considerations for the auditors to think about that video, whether or not they can authenticate it somehow. I think the more reliable you can make that method, whether you have someone from internal audit doing that procedure or just an employee that's out of the inventory process cycle, not involved, if they're assisting in that point, that's going to make it a lot easier in being able to rely on that video. Next slide. So the next 3 slides really go into the new AICPA professional standards. Actually, 7 of these were supposed to go into effect in 2020. Like I said, the AICPA realized that due to the burden caused by COVID-19 on companies that they issued SAS 141 in May of this year to effectively defer SAS's 134 to 140 for 1 year, so calendar year in 2021. However, they did also allow that if companies wanted to go ahead and implement those standards in the current year, that they were welcome to do so. I'm not going to go into each one of the standards. I will point out the standard that has the most significant changes from an audit perspective, and it's standard or SAS number 134, and its changes to the auditor's report. So when that goes into play, whether companies early implement it this year or in 2021, you're going to see that the opinion section is going to be the first part of the audit report, then followed by the basis for opinion. And it's going to have some language in there that talks about the auditor's requirement to be independent of the entity, as well as meeting other ethical responsibilities under the audit. The one new thing that it's not mandatory in the auditor's report, but there could be a new section in the auditor's report about key audit matters. Now, that's all going to be dependent upon whether the company engages the auditors to opine on that as well. So again, it's not mandatory. It's going to have to be agreed upon in advance and included in the engagement letters. And that's really the areas that kind of keep the auditors up at night. I think what the AICPA is leaning towards is trying to converge the PCOB opinions, which include critical audit matters, with key audit matters in the AICPA reports. Next slide. And again, here's some of those other standards on this slide and then on the following slide as well. Next slide. And again, all these can be implemented in 2020, but they're not required to. You can defer them to 2021 per SAS 141. And next slide. Now these 2 standards, SAS 142 and 143, these are both new in the current year. The AICPA issued SAS 142, and it goes into effect for calendar year end companies 2022. And it deals with the use of emerging technologies by both management, the company, and also the auditors. But it really pertains to how the auditor uses that emerging technology as part of the audit evidence in the audit. So if they're going to use that, they just got to make sure that they're applying professional skepticism, they're looking to the standards, and they're assuring that each one of the audit assertions need to be addressed around that audit evidence. SAS 143 goes into play calendar year end 2023, and that's really just part of a long-standing project that the AICPA put into effect into improving audit quality on engagements. It centers around accounting estimates and their disclosures in the increasingly complex environment that we're under, and we're seeing a lot more increasingly complex accounting estimates being made by management. And it really goes into further explaining how the audit standards apply to those accounting estimates that are used by management. The focus is going to be more on the point estimates used by management, estimate uncertainty, and then also the potential for management bias. And so auditors are going to be required to center their attention around that area. They're going to have to consider the audit evidence that both supports that management estimate, as well as they're going to have to do searches for evidence that contradicts that management evidence. It also emphasizes the use of looking at the controls that management has in place around accounting estimates and performing implementation and design procedures on that audit evidence and the controls surrounding it. And then it also looks to the auditor to consider whether or not substantive procedures alone are enough, or if the auditors do also need to test the controls, the operating effectiveness of the controls around that accounting estimate. Okay, next slide. So SAS 143 is really a big one. And again, it's one that I think the AICPA is looking to converge to what the PCAOB is doing from the same perspective. Two new standards in 2020, one that was issued at the end of 19, but the two on this slide relate to 2020-05 and 2020-04, and really both of them have been put into place. 2020-05 dealt with revenue recognition from customers, and then the leasing standard 842, it effectively allowed companies, depending on what type of company you were, it allowed you to defer those standards. Unfortunately, I think the revenue one came into play too late because it was issued in June and a lot of companies had already filed their financial statements. ASU 2020-04 deals with the cessation or the potential cessation of the use of the LIBOR rate. It provides optional expedients in that standard for companies to be able to follow, particularly if they have a lot of contracts that use a LIBOR rate, or if they use hedge accounting. It's going to give them some expedients to where they can consider the use of a different rate to really be the continuation of the existing contracts, and they don't have to do any additional analyses. Same with hedge accounting. It wouldn't require reassessment. However, there's some certain nuances in the guidance that need to be looked at in order for those to really apply. And the other thing on this standard, although it went into play in March of 2020, it's only good through December 2022. So anything that happens after that date with respects to a change in a contract due to a change in rate would be under the new standard and wouldn't be allowed to have these practical expedients. Okay, next slide. The standard 2019-12, again, this is simplifying income taxes to the extent you can really simplify them. It went into effect, or it was issued in December of 19, but for public companies, public business entities, it goes into effect in calendar year 2021 and all the others in 2022, and it can be early implemented. And really this ASU just tried to simplify the guidance in 740 by removing some of the practical expedients or exceptions that were in there, not expedients, exceptions. And you'll see those listed on the screen. They deal with intra-period tax allocation, having to establish a DTL for equity method investments of foreign subs. And it also tried to improve the consistency within GAAP and then clarify and amend any other existing guidance in topic 740. Next slide. And then last, just some things that are in the back burner by the standard setters and regulators. The FASB is looking at a project or researching right now whether or not to allow public companies to be able to amortize goodwill like the private entities have the option to. The PCAOB, again, back on the emerging technology, the use of data analytics, they're just looking to see whether or not do the standards need to be amended in light of these new technologies that auditors are using as audit evidence. And then the SEC in the fall, they plan to update Regulation SK as it relates to legal proceedings, the description of businesses, and then also the risk factor section in light of today's business environment, and looking really to make it less burdensome and less costly for companies to have all these disclosures in their report. And they're pointing to an emphasis more on materiality to determine how much can be cut out and how much really needs to be in the disclosures in Regulation SK. With that, that's all the slides I have. It's a lot to consider in the current year. We have a little time left. We have a quarter, so for those 2020 year ends, you have time to determine whether or not you want to implement some of those standards that really can be pushed to 2021, and then just think about and get with auditors as it relates to, testing of certain areas that may have changed now to COVID-19. But thank you.
Okay. Thank you, Lesley. At this point, we're going to post our third polling question. And I ask that you all take a second to answer them. And as we're doing that, we're going to go ahead and jump into the Q&A session. We're running a little bit short on time, so we're going to just take a couple of them. And not surprisingly, it looks like they all are for Mr. Sharp. So Jason, are you looking at the Q&As?
Yeah. So
I think maybe, you go ahead and pick a couple that you want to address.
Yeah, the first one is probably the most common question we get right now. So the Flexibility Act went to 24 weeks on forgiveness, and so people were asking, do I have to pick 8 or 24? Can I pick something in between? We're pretty much of the opinion you can take the number in between. So in other words, if my PPP loan proceeds run out at after 15 weeks, then I could apply for forgiveness then. That seems to be what we're being told by the banks. It's not a pick or choose between the two. It's sort of when the PPP money runs out. One thing to consider, remember the forgiveness aspect does have an employee or worker equivalent aspect. So we've had some people who are maybe a little anxious to go ahead and ask for forgiveness now because they're concerned that at the end of the year they may have layoffs and their employee numbers may not look good and they may get less forgiven. It is only a forgiven aspect. You're still ending up with very favorable loan terms. So I don't know that that's a deal breaker, but maybe it's a consideration. And that speaks to another question that was on here. When can I ask for forgiveness? We're being told that the banks are going to open up the forgiveness portal or the mechanism for asking for that sometime in the next week or so, probably middle of August, that sort of time. Just check with your lender. They're going to know. There was let's see, what was another question? Yes, you can take EIDL and PPP loans. If you got an EIDL loan, it will be an adjustment to the PPP, but you can qualify for both. There was another one about gross payroll. We're not really sure exactly how this is going to work, but I think as long as you can demonstrate that you had payroll in the time frame after your loan till you're asking for forgiveness, whether that's off 941s or ADP and Paychex payroll reports, however you can do it, that should work. There's another question here about citizen residence immigrant status. I have not seen any discussion on that yet on the proposals. I know some of the proposals before had some pretty strict requirements against non-U.S. residents, and so we'll just have to wait and see where that comes out on this one.
Okay, thank you, Jason. So right now we're going to go ahead and show the results from the third poll. Okay, so looks like 75% of the people on the call did participate in the PPP loan. Fantastic. Okay, well, at this point, that's about all we have time for today in our session. I want to thank you all for your attendance and thank you all for your questions. We were going to take a very short 3-minute or so break coming up, and then we are going to transition into our last session where Briggs & Weselka Managing Partner and CEO Sheila Enriquez will give her closing remarks. There is a session link in your PDF event agenda, and there also should be one here posted in the chat window. You can go ahead and just copy and paste that session link into your web browser to start the next session, and you'll be good to go. So again, I want to thank everyone on behalf of the firm. Thank you for your participation today. Have a great day.